Hello all of you, I hope you are doing good. So today we are going to do the revision of accounting standard 22, that is accounting for taxes on income. Just listen me carefully. The very simple accounting standard. Now what happened? You can see that on the screen there are so many things we are going to cover here, but very simple that here. But first I want to give you the introduction. Why there is a need of accounting standard 22, that is accounting for taxes on income. As you can see that here, this accounting standard talks about the accounting for taxes on income. So it talks about what? It talks about the income tax. Okay, taxes on income. Now understand this one. When we prepare a financial statement of company, what we find it out that here? We find it out that here, the profit or loss of the company. Correct? In a statement of P&L account, we find it out, suppose profit. So what happened that here? Generally, people presume that no, on that profit we are going to pay the taxes that year. Not necessary, because when we talk about the Income Tax Act, we have to find it the profit on the basis of tax law. So it means my accounting profit and my taxable profit is not same, because there might be certain expenses which I am recording in accounting, but the same is not treated as an expenses in tax law. You know that here. But it might be happen there are certain income which we recorded in the tax in accounting, but we don't record and we don't consider the taxable income in a tax law. So it means that the profit which is coming in my accounting and the profit which is coming as per the tax law is not the same. So you will tell me, so what's the problem here? People will say that here we are going to pay the tax on the basis of tax law, on the basis of tax law. Correct. So we find it on the profit on the basis of tax law. So we are going to pay the tax on that. Correct. But there's a one problem here. You will tell me, sir, what's the problem? I will say there's a violation of some basic accounting principle. What is the violation of basic accounting principle? There is a matching principle. Why this is a violation of the matching principle? The reason is that here now, because suppose you have a profit of, let's say that here, 1 lakh rupees as per the accounting. As per the accounting, I have a accounting profit. Let me call it accounting profit. I have a profit of 1 lakh. But in my tax law, if I say that here now, if I say taxable profit, okay, taxable profit, it is something else. Let's say that here, it is coming, let's say that 80,000. Okay. So I am going to pay the tax. I am going to pay the tax as per the tax law. Correct. As per the tax law, I have a profit of 80,000. We have to pay the tax on these 80,000, whatever the rate of tax. Okay, I'm going to pay the tax on this 80,000. But this is a concept of the matching principle. I have an objection here. I will say, listen. In your profit and loss account, you are recording the tax on these 80,000. But actually, the profit which is reflecting in my P&L account is not 80,000. Is what? Is 1 lakh. So the tax should appear in my P&L account on 1 lakh, because on these days, on 1 lakh, complete 1 lakh that year. So 80,000 that we understand, that is as per the tax law. But the difference of 20,000, that I want to record the tax on that 20,000 also that year, because of the matching principle. So accounting standard 22 says, yes, you can record it, but up to a certain limit, up to a certain extent we can record. So you will ask me, sir, what do you mean by certain extent that here? Because I'm saying that in my P&L account with the matching principle, I know that I'm going to pay the tax on this, in our example, 80,000. But apart from this 80,000, I want to record the tax on that difference of 20,000 as well. That is. But up to a certain extent, we can record it, the tax on those 20,000 as well. So you will ask me, sir, why you are saying up to a certain extent that? Because it depends on the type of difference in accounting in the taxable profit. Only for particular type of difference only we can record it. We'll discuss it, the timing difference, the permanent difference, what does it mean, and why I'm saying up to a certain extent that. Because a particular type of differences, tax on particular type of difference only we can record in the P&L account. This is what accounting standard talks about that. So now we'll start our accounting standard 22 revision. So what it says that here now, these standard outlines the accounting treatment for income taxes, emphasizing the matching of expenses with the revenue. There is nothing but a matching. They're talking about what? The matching, the principle that here. The difference in treatment of the tax law may lead to a variation. Variation with differences between the taxable income and the accounting income. Obviously, my accounting profit and taxable profit is going to differ because of the difference in tax law. Now, there are certain definition here. Definition that here. First, what do you mean by accounting income or loss? That is a profit or loss as per the accounting. As per the accounting standard. So net profit or loss before tax for a period reported in the accounting books. This is the profit or loss as per the accounting. Now taxable income or tax, what it says that here? Now it says that here, this is the tax, this is the profit as per the tax law. This is the profit as per the tax law. What is accounting income or loss? That is as per the accounting standard, profit or loss. What is taxable income or loss? That is the profit or loss as per the tax law. Now tax expenses, it means the tax expenses recognized in the books. The tax expense is equal to current tax plus or minus deferred tax here. Okay, so what it says that here now, understand here. They say, what do you mean by tax expense? In my P&L account, okay, in my P&L account that here now, what is going to happen when I say here total tax expenses, I am going to record it. That is current tax. That is what? Current tax, okay, plus or minus. What is plus or minus? I will discuss with you that here is deferred tax. The complete amount is going to appear in my P&L account. So what is going to happen when I say complete amount is going to appear in my P&L account? That is coming what here as per income tax law. So we are going to pay the tax as per the income tax law. But accounting standard 22 tell us that here, no. We have to record there what? We have to record a complete tax due to the what? Matching principle. So on difference only. So when I say this deferred tax, it is basically because of difference. Basically because of difference in the accounting profit and a taxable profit. But when I say basically because of difference that here now, what kind of difference you're talking? Up to I told you that here. Up to a certain type of differences only we can recognize that here. Okay. The two type of difference. First is a permanent difference. What we call it first is a permanent difference. So when I say first is a permanent difference, we don't create a deferred tax on it. No deferred tax. No deferred tax on it. So when I say permanent difference, what do you mean by permanent difference that here now? On permanent, in accounting profit and taxable profit, there's a difference. And I'm calling it a permanent difference. And what is going to happen when I call it a permanent difference that here now? The difference is coming here. The difference is coming here that here now. And that is not going to reverse in future. We call them permanent difference. And we don't create any deferred tax on that here. So let me give an example that here. Suppose when I say that here, suppose as per the law, as per the tax law, if we pay a certain fine which will not be treated as what? Expenses, even though it is an expense. So when we do accounting, we record the fine if we paid as an expense when we do the accounting because we paid that. But when we talk about the tax law, they say no, even though you have paid the amount, this fine is not an expense. It means the difference is coming in the accounting profit and the taxable profit. But that difference is not going to reverse. Reverse means it is not going to happen that in future that 20,000 is going to record as an expense in the tax law. It is not going to happen. So they say the difference is permanent. There is a difference and it is not going to reverse. Now second type of difference, we call them a temporary difference. We call them what? A temporary difference. So what do you mean by when I say that a temporary difference? What do you mean by that here now is a temporary difference that here. So when I talk about the temporary difference, it might now understand what is this on temporary difference that here now we are going to create a deferred tax. We are going to create a deferred tax. Now first you have to understand what is temporary difference that here. Okay. In case of a temporary difference, the difference is coming but it will be reversed that here. Let me give an example. Depreciation. For example, I am following straight line method while I am doing the accounting. So suppose the life of the asset is 5 years. So I am going to depreciate the asset over a period of how many years? 5 years. So I am going to depreciate the asset over a period of how many years? The 5 years. So what is going to happen? Every year 20 years I am going to charge a depreciation and that we are going to depreciate over a period of 5 years. But now, if I say that, but as per the tax law, no, every year you have to depreciate, let's say that here, 10% only. Example. So the thing that I'm going to depreciate while I'm doing the accounting, it takes me 5 years to depreciate. Correct? Because I'm 20% every year I'm charging. But while I'm doing the as per the tax law, I'm going to depreciate over a period of suppose 10 years. For example, that here, the best example, scientific research. Suppose they see that here, okay, you have to depreciate the equipment of science, suppose in 1 year only. So in tax law, I'm depreciating in 1 year only, the same thing. But as per the accounting, I'm depreciating over a period of 5 years. But overall amount will be same. Suppose the amount of the asset is 1 lakh rupees. So in tax law, as per the income tax act, I'm depreciating in 1 year only that 1 lakh. But under the accounting, I'm depreciating that 1 lakh 20,000 over a period of 5 years. So difference is going to come every year. Why difference is going to come every year that year? Because in one case you are depreciating in 1 year only. In another case, you are depreciating the same item over a period of 5 years. In my accounting profit and taxable profit, a difference is going to come. But that difference is going to reverse here. What do you mean reverse? Overall, it will be 1 lakh only. Because as per the tax law, we charge 1 lakh. As per the accounting also, we are going to charge 1 lakh only, but over a period of 5 years. So difference is going to come, but not at the difference is going to come, but that difference is going to reverse in future. We call them temporary difference. So if it is a temporary difference that here now, should we create a deferred? How to create it? I will tell you. Don't worry for that. But should we create a deferred tax on it? The answer is yes. We have to create a deferred tax on it. Okay. Now, when I say there are two types of deferred tax that I will discuss with you, that it might be a deferred tax liability, or it might be a deferred tax asset. Now, what is deferred tax liability? What is deferred tax asset? I will tell you that here. Very simple. We have a table here. It will help you that. Now understand. Now, first there are two types of different. Okay. Now, also whatever this is current tax, the tax that we are paid on the current tax, we are paying on the income tax as per the income tax law. Whatever the taxable profit on that with the tax we are paying, we call them current tax. Okay. What is deferred tax? The difference between the timing difference. This temporary difference is also known as timing difference. So temporary is also known as timing difference. So the difference between, because of the timing difference, the example I gave you of depreciation, so we call them the deferred tax. To understand this point here. So timing difference is nothing but a temporary difference. Okay, same thing. Okay. Now what happens when I say the timing difference that here now? What is this timing difference? Arise when taxable and accounting income differ for a period capable of reversal. A reversal in subsequent, this leads to deferred tax recognition. So the difference is coming in accounting and taxable profit, but this reverse is going to be, the difference is going to be reversed in future. We call them the timing difference or temporary difference. Both are same. Okay. The machinery used for business related scientific research get a full deduction in the first tax year, while accounting spread the depreciation over its useful life. Although total depreciation and tax deduction align eventually, the difference period can lead to deferred tax. They are saying that here. In tax law, they depreciate in 1 year only, but in accounting over a period of time, but overall it will be the same year. So how to calculate the deferred tax here? So deferred tax basically on the difference amount. So when I say whatever the timing difference, okay, temporary difference is coming, multiply by the rate of tax. Now whether it's a deferred tax liability or deferred tax asset, simple rule remember in your mind. What is the rule that here? If it say that here it is a deferred tax liability, recorded when you pay less tax now and more later. It means remember these basic rules that if I'm paying the less amount of tax during the current year, but I am going to pay more amount of tax later year. So we are going to create a deferred tax liability. If it is a deferred tax asset, when I am to pay more amount of tax now and I am to pay lesser amount of tax later, it's a deferred tax asset that year. Okay. So let's take an example that here. First about a deferred tax liability. Okay, when I say under the expenses in tax means tax law. Expenses in tax law. Okay, don't say tax expense. Expenses in tax law. If it is more than the account, books means the accounting. It is more than the accounting. So what is going to happen? It means under the tax law, my expense is more as per the accounting. So I recorded more expenses in tax law. So lesser amount of profit, I am paying less amount of tax now. It means more amount of tax later. So it is a deferred tax liability. Less amount of tax now, more later, deferred tax liability. Now, third one, income in tax is less than the income as per the books of account. So lesser amount of income in the tax law. So lesser amount of profit, lesser amount of tax. So less tax now, more tax later. It's a deferred tax liability. Okay. Now let's talk about the deferred tax asset. Expenses as per the tax law is less than the expense as per the books of account. So less expenses as per the tax law. Less expense, more profit. So more profit, so more tax. I am paying more tax now. So more tax now, less later. It's a deferred tax asset. Okay. Then income in tax is more than the books of account. So more amount of income in the as per the tax law, more amount of profit, more amount of profit, more amount of tax. More tax now, less later, it's a deferred tax asset. This is how you have to decide whether it's a deferred tax asset or deferred tax liability. Now, what happened? The situation are seen in the first year they occur. Now, very important that is. When we see the whether it's a deferred tax asset or liability, we are going to see that whether it's a deferred tax asset or liability that year only in the first year, and later year it always be reversed. Now understand that here. What is going to happen if it is a deferred tax liability? Okay, you have to see that here. Okay, just give me a minute. I think it is okay now. Yes. Okay. Now we have to see that whether it is a deferred tax liability or deferred tax asset. If you know that when it is deferred tax liability, when it is deferred tax asset, okay. If it is deferred tax liability, what I will do in first year, and this is future year, understand here, future years. So in my first year, I will create here. What I will do that here? I will create here. So I will create a deferred tax liability. I am to pass entry, profit and loss account will be debited and deferred tax liability will be credited. And later on it will be reversed, means cancel. We just to pass a reverse entry. So deferred tax liability will be debited and profit and loss account will be credited. But when the deferred tax asset has debit balance, so deferred tax asset account should be debited and profit and loss account should be credited. And in a future year, we are going to reverse them. Profit and loss account debit to deferred tax asset account should be credited here. Remember this. Okay. So when we decide it's a deferred tax asset or liability only in the first year. First year means in which the difference comes that year. First year difference. Later on it will be reversed only. So first year you have to decide whether it's a deferred tax asset or liability. Later on it will be just a reversal of the deferred tax that we have created. Okay. The first year of what? First year of the difference that year. Okay. The second type of difference is a permanent difference. Now for a permanent difference, we don't create any deferred tax asset and liability. So they say arise when the taxable and accounting income differ for a period but do not reverse. So there is a difference between accounting and the taxable profit, but it will not be, I mean to say that here, reverse later. Like the fine, I give an example of fine. Example is fine for the late tax payment considered as an expense in the profit and loss account, but a permanent difference, it does not reverse. So permanent difference don't lead to a deferred tax asset or liability. We are not going to create a deferred tax asset or liability. Now understand this, what is the journal entries for accounting for taxes? So what is the normal entry for the current tax, not deferred tax? So tax is an expense to tax account debit to cash or bank account. When it's come to deferred tax liability, so we are going to pass entry profit and loss account debit to deferred tax liability, and then we'll reverse it deferred tax liability account debit to penal account. Okay. So this creation will happen in the first year and reversal in the future year. It is a normal tax. So the deferred tax is a difference, okay, between the accounting and taxable profit. But if it is a deferred tax asset, so we are going to pass first year entry the deferred tax asset account debit to penal and then reverse penal account debit to deferred tax asset. Simple it is. Okay. Now there are certain points which are related to that here. Now recognition of what deferred tax asset. So they say when I recognize the deferred tax asset in first year, when we recognize the deferred tax asset in first year, they say we have to keep in mind what we should have to keep in mind. They say include the tax expense covering the current tax and deferred tax in determining the net profit or loss for the period. If you're reasonably certain, if I am reasonably certain that here now, what is reasonably certainty that here? That we have a need for the sufficient future income to take advantages for the deferred tax. I am reasonable when we can recognize the deferred tax asset in the books of account, when we are reasonably certain that we have a sufficient that here, the future income we have. So when I can recognize the deferred tax asset that year, we have a sufficient income in the future that year. Then we can recognize the deferred tax asset. But they say if we have a carry forward losses or unabsorbed depreciation, so this reasonable certainty is not sufficient. They say we should be virtually certain. Now remember these two words, okay, these two words, reasonably certain and virtually certain, that is. So normally when we recognize the deferred tax asset, they say reasonably we should be certain. But they say if we have a carry forward losses or unabsorbed depreciation, to recognize the deferred tax asset, it is not sufficient only reasonably certain. We have to be virtually certain. Now they say if to recognize the deferred tax asset, so they say normally we should be reasonably certain. But if we have a carry forward losses or unabsorbed depreciation, then we have to be virtually certain. What is virtual certainty? What does it mean? That here we should, it means almost 100%. What is virtually certain means? Almost 100% that here now I am sure that we have a profit in future. So we should have a convincing evidence that here, yes, almost 100% we have a profit in future. Now the question arises that here now, what do you mean by, okay, what do you mean by virtually certain? What do you mean by virtually certain that here now? There should be convincing evidence that now. Okay, now understand that here. This, it is all virtually certain means almost 100%. This is determining the virtual certainty for future taxable income require a judgment evaluated by case. It's a practical certainty, not based on solely on the forecast like the business plan. These certainty needs convincing evidence which must be available at the reporting date in a concrete form, such as a profitable binding export order that with potential heavy damages for what? The cancellation that here. So now understand that with the example that they say I am virtually certain. What do you mean virtually certain? I have convincing evidence, concrete evidence, almost 100%. We cannot say I have a business plan, so I am going to make a huge profit. It doesn't matter what plan you have. So that is, they say now what is concrete evidence? What would be convincing evidence here? I have export order. I have export. Okay, I have an export order that here, and they say it's a binding that. They say I have to deliver, otherwise there will be a heavy penalty. It means I have to export that here. It's an agreement. Okay, I have an export order. When I will export, I will make a profit that here. So I can show that I have an export order, even though when it is going to first require to virtually certain when we have a unabsorbed depreciation or carry forward of losses. In that case, if you want to recognize the deferred tax asset, we should be virtually certain. Convincing evidence like the export order I have. Okay. So normally to recognize the deferred tax asset, reasonably certain. But there is one exception. In case of a unabsorbed depreciation or the carry forward of losses, we have to be a virtually certain. What is virtually certain? Convincing evidence like the export order that we have. Okay. Now I'm coming to a point that here now, that is the point number 6. Now, I told you that here now, initially that we recognize deferred tax asset when you are reasonably certain, or in case of unabsorbed depreciation or carry forward of losses, that is virtually certain. They say, but they check the unrecorded deferred taxes. Why we have not recorded these deferred taxes? Because we were not virtually certain. So during, for example, if I say that here now, on 31st, okay, just give me. On 31st of March. On 31st of March 2026. We didn't record these we didn't record these deferred tax. We didn't record these deferred taxes. Why we didn't record these deferred taxes? Because we were virtually not certain or reasonably not certain, whatever the case. But later on that year, we are reasonably certain, or we did say that here now. When I say that here, what is going to happen when we are reasonably certain that here? Okay, reasonably certain or virtually certain that here. What is virtual certainty that here now? Almost 100% that here. Okay. So when I say reasonably certain or virtually certain happens, suppose on 31st of March 2027 that here now, then we have to recognize it. Why? Because I am now reasonably or virtually certain, whatever the case. So they say we have to reassess the unrecognized deferred tax asset at each balance sheet. Here we didn't recognize. Why? We didn't recognize here because we were not virtually or reasonably certain. The recognized previously unrecognized deferred tax asset when it's become reasonably or virtually certain that sufficient future taxable income will be available. You got the point? Is what they are saying. Now the reverse of it that Now we have to review the deferred tax asset at each balance sheet. So it might be happen that here on, let's say that here on 31st of March 2026 that we recognized. Now here, if I say that here now, not reasonably or virtually certain on 31st of March 2027. So what we have to? We have to de-recognize, because now we are not virtually reasonably certain. So we have to review it at each balance sheet date. So they say review the carrying amount of deferred taxes at each balance sheet date. Write down the carrying amount if it's no longer reasonably or virtually certain that sufficient future taxable income will be available. Reversal of written down is permitted when it's reasonably or virtually certain that sufficient that future taxable. Now again, suppose in future you come to that reasonably certain, then again you can recognize. This is what they are saying. So basically, to make it simple, on each balance sheet we have to see that whether it is certain or not. If it is not, so if we have recognized previously, we have to cancel them. If suppose we have not recognized previously, but now it is certain, so we have to recognize. This is what they are saying. Now there are two types. Now after, let me discuss the special cases, then we'll come to the question that you know. Now there are two type of special the cases. Let's discuss that here. Okay. Or should I take, okay, now understand this point here. Okay. Let's go to the super 100 question that I will come to that point. Don't worry. Now come to here now. Question number 69. I will come to that special concept. Okay. Now one by one. It says that Rama Limited has provided the following information. Depreciation as per accounting record is how much? 2 lakh. Depreciation as per income tax records 5 lakh. Now decide whether it's a deferred tax asset or liability. So I will say we recorded 5 lakh as per the tax law. More expense, less profit. Lesser amount of profit. So, and the more amount of, lesser amount of profit, lesser amount of tax. Less tax now, more tax later. It's a deferred tax liability. Okay, remember that rule. So deferred tax liability. Okay, now here on the difference amount. So 5 minus 2, that is going to come on 3 lakh. Multiply by, or you can see that, let's first calculate that here. 3 lakh, rate of tax is given is 50%. So you can see the deferred tax liability of how much here? 1 lakh 50. Then it's a different point. Then it says that unamortized preliminary expense as per tax record. It means we have not recorded as per the tax law preliminary expenses of 30,000. So in a tax law, if we have not recorded 30,000, so expense not recorded, lesser expense not recorded, more amount of profit. So more amount of profit, more amount of tax. So more tax now, less later. Okay, so it's a deferred tax asset. So this is deferred tax liability. This is deferred tax asset. So 30,000 multiplied by 50%, that is 15,000. 15. So how much? This is deferred tax liability, deferred tax asset. So how much is net deferred tax liability? 1,35,000. Simple. Question number 69. Okay, done. Now 70, I will discuss it. Okay. Now do one thing that, okay. Now here come to question number 71. What it says that here now? They say that here the PQR Limited, okay, PQR Limited accounting year ends on 31st of March. I will come to question number 70 later. Okay, just listen carefully. So PQR Limited accounting year ends on 31st of March. The company made a loss of rupees 2 lakh for the year ending 31st of March 2015. So first year they have a loss of rupees 2 lakh. For the year ending 31st March 2016 and 31st March 2017, it made a profit of rupees 1 lakh and 1,20,000 respectively. The first year they have the loss of 2 lakh, then they have a profit of 1 lakh and 1,20,000. It is assumed that the loss of a year can be carried forward for 8 years and the rate of tax is 40%. By the end of 31st March 2015, the company feels that there will be sufficient taxable income in the future year against which the carry forward losses can be set off. There is no difference between the taxable income and the accounting income except that the carry forward losses allow in the year 16 and 17 for tax purpose. Prepare statement of profit and loss for the year ending 31st of March. Okay, 31st of March. Year ending for the year ending on March 30. Year ending 2015, 2016, 2017. But okay, they are ending on March only. That is okay. Now understand what they're saying is. So 31st of March, listen very carefully. 31st of March 2015, 31st March 2016, 31st of March 2017. So they have a loss of rupees 2 lakh in the year what? They have a loss of rupees 2 lakh on 31st of March 2015. Okay. Now, as per the accounting, and they tell us that here now. Listen carefully. Okay. They tell us that here now. These 2 lakh loss can be carried forward to future. Now listen carefully. It means these 2 lakh I can carry forward to next year. Correct. In the next year, if it is carry forward, I am going to less amount of tax later. So if you are going to pay the less amount, if you are going to pay the less amount of tax in future, okay, less amount of tax later, lesser, it's a deferred tax asset. So it says that here now, if I have a loss during the current year, and this loss can be carried forward to the next year. So next year, it will be adjusted against the profit. I'm to pay lesser amount of tax in future. It's a deferred tax asset. So the rate of tax which is given in question is a 40%. So I'm going to create a deferred tax asset here. So for your reference, I mean, first year we have to decide whether it's a deferred tax asset or liability. If we decided deferred tax asset first year. So let me write it down. Just give me one. First year, future year, future years. Okay, there are 2 years. Future. Okay, now understand this. So what happened? I'm to create an entry. Past deferred tax asset account will be debited to profit and loss account. So deferred tax asset account debit to profit and loss account. What it says that here now, the 2 lakh is the amount, difference amount it is mentioned that, okay. And what is the rate of tax? 40%. So that is coming 80,000. Let me write, okay, space is 80K, 80,000. Okay, so we created deferred tax asset. Okay, now please understand that here. For your knowledge, okay, I'm a little bit in depth that here. If I create a deferred tax asset account, okay, if I create a deferred tax asset account right now, okay, let me create a deferred tax asset account here. Just 1 minute. Okay, this is a deferred tax asset account. So first year, you create a deferred tax asset debit by 80,000. Okay, first year. So I have a balance of 80,000 here, and it will come as an opening balance in next year. This is first year, second year, and the third year will also come. Okay, understand that. Now, what entry we have passed here? Deferred tax asset account debit to P&L account. So we debited deferred tax asset and P&L account credited. So you can see that here the balance is coming that here now 1,20,000. Balance is coming here 1,20,000 in your P&L. If I say this is profit and loss account, how much loss I have? We lost the debit balance. How much loss we have that here? 2 lakh. 2 lakh we have a loss. Okay. And we pass the entry that here now is the 80,000 deferred tax asset to P&L. We credited the P&L by 80,000. So it means we have a net loss of how much here? 1,20,000. You can see that here it is coming 1,20,000. Okay. Now we come to next year. Now they say next year we have a profit of 1 lakh. So, but what happened is that how much the tax come on the profit? But what happened that is coming 40,000. But we don't have to create a current tax here. Why? Because the carry forward, last year carry forward of 2 lakh will be adjusted against this 1 lakh. So this 1 lakh, the profit that we have, this out of this 2 lakh, it will be adjusted that year. So this 1 lakh will be adjusted against the carry forward losses. Correct that here now. How much tax basically? Now we have to do the reversal. So reversal, when I say I'm just to reverse the entry deferred tax asset to P&L, when I will reverse it, I will pass entry P&L account will be debited to deferred tax asset account. That is 40,000. How much that is coming? That is 40,000. So when I say the 40,000 here now, what is going to happen? We pass the entry that here now is the profit and loss account should be debited and deferred tax asset account should be credited here. That is coming how much here is the 40,000 here. Why 40,000? 1 lakh multiplied by 40%, 40,000. Now, if you post this entry, we are going to debit to P&L account. So if I come to next year, I have a profit P&L account. I have a profit of 1 lakh. Profit is credit balance. Profit of 1 lakh. You debit it to P&L account by 40,000. How much profit is coming now? 60K. You can see that 60K profit like that. Okay. So what entry we have passed? P&L account debit to deferred tax. Deferred tax asset account will be credited by 40,000. So we have a balance of how much here? 40,000. So when I go to third year, how much balance I have? 40,000. Now we go to third year, we have a profit of 1,20,000. So when I calculate the 1,20,000 multiply by 40%, that is coming 48,000. 1,20,000 multiply by 40%, that is coming 48,000. But we have a deferred tax of only 40. So we can adjust maximum up to 40,000 in a deferred tax. Same entry I will pass. P&L account debit to deferred tax asset account 40,000. 40,000. So maximum, how much we can adjust? We can adjust maximum how much? 40,000. Okay. So when I say maximum, we can adjust up to 40,000. So we adjusted this 40,000. But for these, it's a current tax, other than the deferred tax. Okay. So we are going to pass entry a P&L account debit to provision for tax account. Or okay. So this is the entry that we have to pass. Okay. Now here, if I go to this here, again to my P&L account, how the 72 is coming there? How much profit we have? We have a profit of 1,20,000. Here the entry, what entry we pass for the reversal of deferred tax? P&L to deferred tax asset. So here I will write it down that here, P&L account I will debit to deferred tax asset. Okay. How much is 40,000? Okay. Now here the current tax, how much is 28,000. So you can see the balance will come 72,000. Like that we do the accounting in real life that. Okay. So you just have to see why we are creating the deferred tax. Mainly we create only for the differences that is. You got the point? Okay. These type of question comes in examination for how many marks? 7 marks that is. Okay. So first they create a deferred tax and then they reverse it in the next 2 years that is. Okay. Now, if beyond that, that is not a deferred tax, it will be part of what? Current tax. Okay. Now come to question number 72 that. What it says the question number 72 that here now. They say Omega Limited that here is working on a different project which are likely to be completed within 3 years. So it recognizes the revenue from these contract on percentage of completion method for the financial statement during 14, 15, 15, 16, 16, 17, rupees 11 lakh, 16 lakh, 21 lakh, respectively. What they have done? 3 years that they have 14, 15, 15, 16 and 16, 17. As per the accounting, they have a profit of 11 lakh, 16 lakh and 21 lakh. Total is 48 lakh. But they say, however, for the tax purpose, it has adopted a completed contract method under which it has recognized the revenue of rupees 7 lakh, 18 lakh and 23 lakh for the year 14, 15, 15, 16, 16, 17. So they have a profit of 7 lakh, 18 lakh and 23 lakhs that year. This is the profit diagram. So overall it will be same 48 lakh, 48 lakh. It's a temporary difference only. But individually we'll say that 11, 7, 16, 18 like 21, 20 like that. The difference is coming that year. Now, is it a deferred tax asset or liability? You have to understand this here. The difference is coming 11 lakh and the 7 lakh. How much the difference is coming? It's a 4 lakh is the difference right now. So how much here they have to create a, deferred tax liability or asset. We'll discuss that here now. If I say my accounting profit is more than the taxable profit, we pay the lower amount of tax here because we are going to pay the tax on the 7 lakh. How much the difference? 4 lakh. 4 lakh multiply by what is the rate of tax given? 35%. So if I say 4 lakh is the difference is coming, multiply by how much? 35%. So 4 lakh multiplied by 35%, that is coming 1,40,000. So I'm paying lesser amount of tax now. So it's a deferred tax liability. So profit and loss account should be debit to deferred tax liability first year in 2014 and 15. Okay. Now 1,40,000. So they created by 1,40,000. Okay. So how much balance we have in a deferred tax liability? We have 1,40,000. So if I prepare this deferred tax liability account, so P&L to deferred tax liability, how much? 1,40,000. So we have a balance of 1,40,000 in first year. It will go to next year 1,40,000. Now next from the next year it will get reversal. The next year the difference is 16,000 with 18. Don't say sir, we are paying the more profit in the tax law, so more tax to the deferred tax asset. No. Only first year we have to decide whether it's a deferred tax asset or deferred tax liability. Later on it will be just a reversal of that. Okay. Now they are doing the differences. They are doing a reversal that Now, what is going to happen that year? So, how much is the difference is coming? 2 lakh. So, 2 lakh multiply by 35%. That is coming how much? 70,000. So, I'm going to pass entry. Deferred tax liability account will be debited to P&L. So, I'm going to debit a deferred tax liability by 70,000. I have a balance of 70,000. Okay. So, this balance will go to next year. Okay. Now, I'm going to third year. Now we have a deferred tax liability balance there. Here, remember they're talking about the balances here. The difference that here 4 lakh, then the balance is that difference is the 2 lakh. Here the deferred tax liability balance is 70. You can see that here it is 70 and here it is also 70. Now come to third year that. Again the difference is coming 2 lakh. It is a reversal of that. Okay, first reversal. So again difference is coming 2 lakh. So we are going to pass the entry. Deferred tax liability will be debited to profit and loss account. 2 lakh multiplied by 35%. That is coming how much? 70,000. 70,000. Okay, so deferred tax liability will be debited by 70,000. That it will get closed that is. Therefore, the balance is coming how much? 0 here. Okay, simple. Okay. Now there are two more concepts that we will do the revision that of that is the first is special cases is that accounting for taxes on income in a tax holiday situation. What is tax holiday situation that now? Is up to a certain period that year, they said you are not going to pay the tax. Okay. So let me explain it through an example that it will be easy for you. Okay. See that here now. The summary that they have given, they have mentioned the example that, listen carefully that. Okay. Now they say that here, there is a difference in a first year and a second year. So they have a difference here of rupees 1,000 and rupees 2,000 in first and second year. So, but they say that company is not going to pay. The timing difference is coming in first and second year, correct? But that difference is going to start reversal from the third year. Okay. So how much they say from the third year is mentioned in example that year. From the third year, the reversal will start. So when I say from the third year, when the reversal is going to start that year, now how much it will be reversed? They say 50-50. Okay. 50-50%, 50 amount I'm saying 50-50-50. But they say when the up to a 10th year, they are not going to pay any amount of tax as per the special economic zone, whatever is that. They are not going to pay any amount of tax here. So up to the 10th year. So these first year reversal is 4,000, second year reversal is 2,000. And then these 3,000 started reversing from the third year, 50,000 every year. So if it is going to reverse from the third to 10th year, it is going to reverse by 400,000. We are not going to create a deferred tax on this 400,000. The reason is that here now on this 400, the reason is that here now because it is reversing during that period on which there is no tax. So if there is no tax, the question of deferred tax also does not arise. It is what they are saying. So this 400 from this 1,000, I am not going to create a deferred tax on 400 because this 400 is going to reverse during the period on which there is no tax. So 1,000 minus 400. That is going to come how much? 600. So on these 600 on these 2,000, I am to create a deferred tax. Whatever the rate is given in the example, the rate of tax is 40%. So on these, the 40% on these 600,000 and 200,000 that we are going to create deferred tax liability on 1,040. You got the point? This is what they have mentioned. Now listen. They say account. Okay. They say don't recognize the deferred tax asset for timing difference arising reversing during a tax holiday. Means if there is no taxation in that period, if it is reversing, no deferred tax we are going to create. Recognize deferred tax for timing difference originating during the tax holiday, but reversing after the tax period. If the period up to 10th year there is no tax. From the 11th year there is a tax. So whatever it is reversed, it is going to reverse here. Then we are on only that portion we have to create a deferred tax here. So on these 400, which is going to reverse during these period on which there is no tax, we are not going to create a deferred tax there. Okay. Then they say timing difference which originate first should be considered to reverse first. It means these 400 will be adjusted from this first, which is the first year only. Okay, then balance comes the second year, then we are going to create a deferred tax on it. Simple. Now come to the point number B. Accounting for the minimum alternate tax. You know that there is a tax law on which the minimum tax that we have to pay. So they say first normally we have to calculate the, listen carefully what they are saying. Normally first calculate the current tax. Normally calculate deferred tax. And whatever the difference is coming between the current tax and the minimum alternate tax, that we have to write it, calculate excess tax due to the MAT. So we have to just calculate as per the MAT how much is the tax, as per the current tax how much. The difference we have to recognize, as per the tax law. The difference we will recognize. This is what they are saying. Let's take an example so it will be easy for you to understand. Go to question number that here now, the 70. They say from the following details of A Limited for the year ended 31st March 2017. Calculate the deferred tax asset liability as per AS 22 and amount of taxes to be debited to profit and loss account. They have a first, let me write it down, the deferred tax here. Okay. How much deferred tax that they have here? The difference. Accounting profit that they have 6 lakhs. And what is MAT I will discuss with you later. And the tax profit that they have, a taxable profit that they have 60,000. So taxable profit is less. So we are paying less amount of tax now. Later on we will pay more. So it's a deferred tax liability. The difference is 6 lakh minus 60,000. 5 lakh 40 is the difference. Multiply by the rate of tax is given the 20%. 20%. So it's a deferred tax. 6 lakhs minus 60,000 multiply by 20%. That is coming 1 lakh 8,000. So 1 lakh 8,000 that here it's a deferred tax liability. Okay. How much is the current tax? The current tax, as per the tax law, how much is the profit that they have? 60,000. Multiply by 20%. So current tax that they have, 60,000 multiplied by 20%, that is coming 12,000. Now one more point will come. As per the tax, as per MAT. This is the new point that, let me change the color here. Okay. Tax as per the MAT. Minimum alternate tax that here. So how much profit that they have? They have a profit of how much here? They have a profit of how much here? As per the MAT law, they have a profit 3,50,000 and the rate of tax is 7.5%. So they have to pay is 3,50,000 during the multiply by 7.5%. Minus they have already recorded as a current tax 1,08,000. Now understand, 3,50,000 is the amount of profit as per the MAT. Multiply by 7.5%, that is coming 28,000. 28,000, how much here coming is a 250. But they have just give me our current tax is not 1,08,000. Current tax, sorry, is 12,000. That is deferred. Okay. So as per the minimum alternate tax, they have to pay how much here is 26,250. They have already paid 12,000 in the form of current tax. The excess that they have to pay, that is coming how much? 14,250. Not total 1,08,000 plus 12,000 plus 14,250. That is coming 1,34,250. Yes. Okay. Done. So this is all about accounting standard 22. That okay. Now done. So no need for the disclosure. Okay, no need to even read that here. Okay, now we're done with the accounting standard 22. That is, just remember these rule that's here. Okay, you have to decide in the first year only whether it's a deferred tax asset or liability, and then later on it will reverse. To decide deferred tax asset or liability, just follow these I'm to say rules that here. Okay, so that is for today. Take care all of you. Now please, if you like something that here, don't forget to come in your comment section, write something. If you have some doubt, if you want to say anything, just say there, I will give you a reply there. Okay, so that is for today. Take care all of you. Bye bye.